Hello traders, Gary Wagner here, just about 12 noon in Honolulu, 5 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands, August the 4th, 2017, and this is the Daily Report for Gold and Silver, our weekend review, and what a week we have seen. A lot of action in the marketplaces, culminating with the release today of July's jobs numbers from the Labor Department, coming in better than expected and putting a huge fire underneath the dollar, sending that off of a 15-month low. Gold obviously reacting very, very negative to that. 1264, that's the close of most active futures contracts, puts it down about $10 on the day. Silver did not fare that much better, 1623, putting it off almost 40 cents. Of course, a couple of weeks ago, we entered long positions in both gold and silver. And fortune is with us today in that we exited and pulled profits on our silver trade on Wednesday and pulled profits on our gold trade yesterday. We'll talk about that in detail when we pull up a couple of charts. As I said, it was the dollar that was really the entirety of today's market move. When you looked at gold and spot gold with the Kitco Gold Index, it was 99% dollar and a fractional amount of selling that gave us that negative $10 on the day. Dollar index up almost 0.7%, getting off of that 92 and change to close at 93.38. Dow Jones Industrial Average closing at a new all-time record high above 22,000. And on today's report, I will give you a projection of where I think that could go. Nominal moves to the upside in the NASDAQ as well as the S&P. Let's take a look at our first chart. Today's better than expected numbers with the Labor Department's jobs report for the month of July certainly set wheels into motion with some tremendous upside strength in the U.S. dollar and dollar index and dramatic pressure on both gold and silver. Net result is that gold futures, this of course basis most active August contract, closed down by about $9.50 at $1264.90. More importantly, what we witnessed today on this weekly chart was the conclusion, at least for now, of the consecutive move to higher ground that gold has exhibited over the last 3 trading weeks. After trading to an intraday high of approximately 1280 earlier this week, today's dramatic move took the market from about 1275 with an intraday low at around 1259 to settle at 1264. However, before we talk about what I'm looking for next week in my current market analysis, we have a little bit of work to do in that we need to go over trades that we did exit this week. So traders, if you recall, we went long both gold and silver. This is approximately 2 weeks ago. And then we raised our stops approximately 3 times. On Wednesday of this week, we had raised our stop on our long September silver to below 1650. In essence, what we did on that trade is we entered the market just below $16 per ounce, $15.98, and that would be this candle here. As I said, as this market moved up, we consistently raised our stops, and we then put in a stop order to get out at $16.50 or below on a stop. You can see that on Wednesday, August 2nd of this week, the market did come down and touch our stop. We got in at $15.98. We got out at $16.45. for a profit of 47 cents or $2,350 per contract. We are currently flat with no active trades in silver. And so traders, at the same time, we issued the buy signal in silver. We also went long in gold. In terms of our gold trade, we got in at 1232.70. That would be this candle right here. We then began to trail our stops up, and we were knocked out of the market with a profit when yesterday we saw this market come down and breach 1265. That was the last point of our stop, was to place it below 1265. We marked ourselves out at 1264 for a profit of $32 or $3,200 per 100-ounce contract. So traders, with those two trades under our belt, the real question is, what do we think gold is going to do next week? And to that end, I have created a simple technical study. It's a Fibonacci retracement, which starts from the beginning of this rally, roughly at 1203, up till 1280, which was the high that was achieved this week. When we do that, we get our various levels. First level to look at would be 1262, that's our 23% retracement. The low today certainly went below that, but it did close fractionally above that price point at 64.70. But the points we want to look at, if there's going to be continued pressure on gold, would be the 38% retracement. That would be a shallow retracement. As deep as a 61.8% retracement, that would take the price of gold to 1232. And of course, next week's move in both gold and silver will be largely predicated upon strength or weakness in the US dollar. We're looking at a weekly chart, standard candlestick format, this of the US dollar. You can see this extreme low that was hit during the week, which came down at around 92.36. Of course, I'm on record stating that my target was about 92. We could have, in fact, achieved that target this week. And if the market moves off of that price point, we are certainly looking at a couple of different levels where we've gotten some technical support. We can see this recent low that came in just after April of 2016 and this other low. My sense is, though, even if we see this market bounce next week and the following week, I still think we are headed in a downward trajectory on the dollar index, and I'm still looking at a target for about 92. The question is, what kind of upside bounce will we witness next week and maybe over the next 2 weeks? And traders, extremely noteworthy and really capping itself off today was a strong move in the Dow Jones Industrial Average, closing up about 66 points, a net gain of about 1/3% to close well over 22,000 at 22,092. That certainly means that this week resulted in the highest close on record for the Dow Jones Industrial Average. The S&P has been flatlined over the last couple of weeks, and the NASDAQ has actually been under some pretty substantial pressure. So it is the Dow recently that has been the one to watch in terms of U.S. equity indexes. If you recall from yesterday's show, we attempted to look at a potential top in the market. When you're looking at a market that is at an all-time historical high, the only way that we can even begin to get any kind of forecast is to do a Fibonacci extension, and that's exactly what we have here. We talked about it a little bit yesterday, but just to recap, what we're doing on this Fib extension is we are beginning at the onset of the rally that came in right after the devastating fall from grace, in which U.S. equities really broke 14,000 only to trade dramatically lower below 7,000. From there, we had a multi-year rally. We've had a couple of fairly modest retracements. However, it wasn't until we reached our top just at around 18,000 plus that we had a series of pretty deep corrections here and here. So the way that I am doing this particular extension is the first wave that I'm looking at for the extension takes us from this bottom here to this top. I then fix on this particular price point at 15,243, and then we do our extension. The most logical thing to look at is a 61.8% extension, and that would take the Dow Jones Industrial Average to 22,629. That is my current forecast for the Dow. Over time, there will be peaks and valleys within that, but before we get a major correction in the market, I think that this is the price point we could see the Dow move to over the remainder of this year. You know, traders, by trailing stops up, we put ourselves in a scenario in which if the market continues to move in our anticipated direction, we can continue to profit from that. Such was the case on this most recent trade in which we're long gold and silver. We raised our stops, I believe, 3 times each in both gold and silver, and then got knocked out in a profit on Wednesday in silver, on Thursday in gold, and fortune was certainly with us. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for another daily update and review. Have a great weekend. Bye-bye.